Hello? Hello? Hello?
Hello.
Hey, Samir. How are you?
Hey. Can you hear me, Raj?
Yes, we can. Just wait a second. I'm just going to introduce and kick off the forum.
Hello.
Okay, well, let's go again, everyone. Good evening and welcome to Smartkarma's weekly forum. We're waiting for attendees to stream in, and I've also got with me Samir Taneja, one of our analysts, to sort of discuss one of the key ideas. Hi, Samir, can you hear us?
I can hear you, Raj. I can hear you.
Fantastic. So just while we wait for attendees to stream in, I'm going to run through our disclaimer. So, our forum is strictly for subscribers. It's meant purely for informational purposes. It does not constitute investment advice. It is the opinion of our insight providers and not that of Smartkarma. And lastly, Chatham House rule applies. So please do not share any of this information on any public forum or social media without our express permission first. Samir, just before I begin, what I typically tend to do is I run the attendees through some of what we discussed in prior weeks, just very, very briefly. It gives everyone a sense of the breadth of ideas that we feature, and it also helps explain that the format of the forum, where we typically feature one small cap, one large cap, and one theme every week. So last week, for instance, we looked at Del Monte, which is a Singapore-listed company with a dual listing in Philippines. And we looked at how one might play the balance sheet restructuring at Del Monte. We also explored the Philippine Stock Exchange itself, PSC, which is listed, and what could be some of the merits of that particular investment. Then in the large cap section, we looked at an upcoming IPO called WeDoctor, which is a front runner in digital medical services in China, clearly a very hot area right now. And we examined how it stacks up versus some of the peers that are already out there. And lastly, we had Osbert dial in from Shanghai to talk to us a little bit about China private education and some of his top picks. Clearly a big growth area at the moment within the Chinese equity space. The week prior to that, we took a look at TVB, television broadcasting, which is a Hong Kong monopoly. The share price is down nearly 85% from its highs. And we examined how it could potentially be shaping up to become a privatization candidate. We also looked at how the issue of eminent domain, a fairly technical but interesting issue, could crop up in Hong Kong. This is when the government appropriates privately owned land for strategic reasons. And then we also took a look at the management buyout situation at Toshiba. This is sort of a very big activist situation unfolding in Japan at the moment. So like this, again, every week, a small cap, a large cap, and a particular thematic. We are very happy to share slides or recordings of previous forums with you if you've missed any of these. And the idea is always to build on the ideas previously discussed and maintain continuity. So just as a bit of a recap, I think since December of last year, about 56 different ideas have been presented in the weekly forums. We're also sharing with you how these ideas have performed till date. Of course, we're going to look at these on a sort of a trailing 6-month or 12-month basis. So the ideas from December on average have returned about 29% per idea, from January about 16% and so on. Now, some of these ideas are IPOs, which aren't even listed at the moment, or SPACs and so forth. So there will be a little bit of a mix, and some of the themes are sometimes harder to track as well. But this gives you a general picture, and it sort of informs you how we try and stay on top of this in a very objective manner. So today on the agenda, we've got, Oriental Watch, a Hong Kong listed company, 398 Hong Kong. And Samir is here to talk to us about it. Hi, Samir, can you hear us?
Hi. Yes, loud and clear. Can you hear me?
Yes, perfect.
Okay, perfect.
Just a tiny bit of an introduction. I think Samir's been on the forum before. He's based in Singapore and he's looked at stocks around Asia, even globally. And I think increasingly Samir looks at, very high quality value and growth situations. And, Oriental probably falls more on the value side of the equation, but there are certainly some growth characteristics to be looking at. So Samir, we just put together some bullet points, but I think with Oriental, the key thing that you've been highlighting in your latest research notes on Smartkarma has been, the second half results, which come out in
Yes.
May. So we're in May now. Can
Right.
you briefly talk to us why these results are important for the company?
Sure. Just a small correction on the results. The results are actually on June the 20th. All right. So just to start with that.
Let's change that.
Yeah. So the results are June 20th. And the reason why the results are important is because the company has been experiencing some very, very strong growth in the second half, which is September to March. The same store sales growth were averaging close to 60 to 70%, driven primarily by China, where growth rates were in excess of 100% for the Rolex and Patek Philippe stores that they have. That with that as the backdrop, I feel really confident that results will be very, very good year on year, especially for the second half. And this is probably going to result in the company paying out a very hefty dividend. So just to recap, this company has very good payout ratio, which is in excess of 130%.
Oh, wow.
So the company pays out most of their profit, all of the profits that they make, and then they also pay from their cash pile. So if you look at the share price right now, I think it's about close to 3 Hong Kong dollars, up 2.96 at the end of today. Around 1.75 Hong Kong dollars of this 2.9 is cash. The company is debt free, and they also have inventory of around 1.4 Hong Kong dollars. They also have real estate worth 1.4 Hong Kong dollars. But just per se for like when we are discussing about dividend, there's a huge cash pile from which they will slowly dispense to pay dividend. And then in addition to that, you're going to have very strong earnings. So I feel confident that, the company could come out with earnings that in the second half that could be in the region of 20 to 25 cents. So all that sort of paid out as dividend plus cash over and above that implies a very hefty dividend yield just for the second half.
Understood. So just to sort of, I think Oriental Watch is a luxury watch retailer. I think the name was a giveaway, and you've described it before. But and I think one of the themes that has been quite obvious in the market is luxury watch sales numbers into China have been very strong. There's a lot of people talking about it. Is there a better way to play this in the Hong Kong market, at least, apart from Oriental Watch, both in terms of quality of company and track record and governance and so forth?
Yeah, I mean, there are other jewelers like you have Chow Tai Fook, which can be played. But if we actually sort of look at companies that are similarly profiled, like the Hung Dillies and the Emperor watches of the world, the corporate governance of those companies is are not so good. And at the same time, they've also sort of hitched a lot of their presence to Hong Kong. And so Hong Kong has not had or has not experienced very good same-store sales growth while while they were shut down due to the pandemic. So I would not say that those are the you could play. I would not say that playing those names would be great. Given that this name has like such a good dividend yield associated with it, right, and a very good margin for safety, this kind of is like the name I would prefer.
Got it. So what's quite interesting is, when you first pitched it to us quite some time back, it was a value opportunity, and that value started to get realized. The company did a giant offer to buy a lot of stock as well.
Yes.
And I think they bought stock at $3. Is that right?
Yes, they did. They bought 15% of the shares outstanding at 3 Hong Kong dollars. And despite that, the cash on the balance sheet still continues to be $1.75. And in addition to that now, because there are lesser number of shares, the earnings per share will be much stronger and there'll be more dividend to distribute. Got it.
So let's recap that, right? So this is a company that believes its own shares are cheap. They literally bought back 15% of the company recently at $3, which is where the share price is now, thereabouts. They've gone from being a pure value opportunity to being value plus extremely strong growth. I mean, as we're going to see in the second half. On top of that, they've got a very attractive payout. You said, 130%.
Yeah.
I mean, I had to do a double take there because I think most companies in this part of the world struggle to pay out any dividend, let alone 130% of their earnings. And then you've got extremely cheap valuations. This is 3 times X cash PE. So there's really not a box it doesn't seem to tick. Perhaps if there's anything to fault them for is it's a little bit on the smaller side. It's a small cap after all. But I think for me that's great. I'm just going to open it to the attendees if anyone has any burning questions on Oriental. But I guess this is as straightforward and mind-numbingly obvious as it gets as a bottom-up situation. You can sort of click on the Q&A button on your Zoom application, or even use chat, whatever is easiest. But if you don't have questions, we'll sort of move on to the next idea, and we can always post them for Samir on the Smartkarma platform itself. Samir, I'm not seeing any more questions at this stage. I'm going to let you bounce and get on with your evening. Thank you for joining us.
Thank you very much.
Hope to see you again soon.
Thanks, Raghav. See you. Bye. Bye-bye.
Just as Samir left. Oh, Samir, are you still there by any chance?
I am there. Hello.
Sorry, we have one question coming in, which I think you might be able to answer, which is, what percentage of sales for the company are China versus Hong Kong? So sort of a business split.
Yes, this is quite interesting because there was a time when Hong Kong was 65% of sales a year ago. And China was 35% of sales. But given the strong momentum in China sales and the same-store sales being up 100%, that ratio is inversed. And China now is almost 60% of sales, and Hong Kong is much lesser. The good thing here as well is now the base for Hong Kong is quite low. And so comps will start to get very easy, and Hong Kong will start showing very good growth here on out.
Got it. Fantastic. I'm so glad you were still there because I didn't really know the answer.
Right.
Good stuff. All right, cool. Well, let's move on to the next idea. And then, if you've got further questions on Oriental, we'll always revisit them later. So this is now a very, very different sort of idea. I would probably put it as a mid-cap or large cap. This is a company called China Communications Construction. The ticker is 1800 Hong Kong. The market cap is about somewhere between $7.5 billion US. It trades about $18 million a day, so clearly very, very investable. As you can see, this is not the world's best looking share price chart. I mean, this stock has fallen from about $11 back in 2017 all the way down to about $3.70, right? So this has literally been a one-way street. And I think the other thing you will pick up quickly is that sometime, a few months ago, a lot of volume traded, as you can see here. And this had to do with, the removal of this company from a few indices. And that's something that we covered quite closely on the platform as well. But I think another very important thing to highlight is, despite it being kicked out of a few indices, share price has remained relatively flat since that event happened. So let's look at this a little bit closely. So first things first, China Communication Construction, or as it's called, CCCC. It's a Chinese SOE that's involved, as the name implies, in the construction sector. They do lots of different types of urban construction projects, and they're really one of the companies that's quite heavily exposed to China's fixed asset investment, right? Now, this stock has been very bombed out, but it's sort of turning around, and that's really where the thesis is. The first things to highlight is, in the first quarter of this year, their recurring profit grew 88% year on year. Now, 2021 is a very dangerous year to look at year-on-year comparisons, just because 2020 was so abnormal. So we always compare it versus 2019 as well. Even compared to the first quarter of 2019, profits are up about 13%. Now, first quarter profit is already equal to the full first half of last year. But I think what's even more important is the new contract addition momentum. With any construction company, new contracts are what dictate future revenue and future earnings, and that's important. So new contract addition is enormous. It's up 80% year on year, and also sequentially about 25% quarter on quarter. So this is the chart that you want to be looking at on the right-hand side. And as you can see, there's just really solid momentum to kick off the year for the company. Now, in light of all of this, the stock is extremely cheap. It's trading on just 2.7 times PE and 0.2 times price to book. So this is really a China cyclical that is trading extremely cheap, but it's actually seeing improving business conditions. So that's what makes the setup really exciting, right? Meanwhile, urban construction, which is one of the better areas within its business mix, has actually increased. It is now 44% of the total mix. And the company also gives a 6.6% dividend yield. So you have a 2 times PE stock that's at 80% discount to book value, giving you 6.5% dividend yield and showing improving growth momentum and accelerating new wins. So that's the thesis here. This space and this stock is covered by Osbert, whom you've sort of spoken to in earlier weeks before. Also, maybe just quickly drawing your attention to his latest research piece, which he published on the 30th of April. So, very clearly, there is a return to normal happening, but that is just not reflected in share price. Share prices are still very, very subdued. I think cost management has been very, very good. He talks about it. So margins are actually expanding. The new order momentum is very strong, as we said. If you look at where they're picking up more business, it's not ports, it's not roads, it's urban construction, which we think is an area that can sustain good growth for a while. Also, I think the Q&A has been very, very interesting. So, this company actually has a bit of debt. It is quite levered. And now what they are doing is interesting. So they are actually securitizing a whole bunch of the receivables, which is great. That's reducing the leverage. Also, they are disposing of underperforming assets. That itself is very good. I think the management is under a lot of pressure to do these things. Then the other thing, this bullet point 3 is very good. They're exploring a REIT to securitize a bigger batch of these assets pretty quickly. However, I think this might be some way off. As Osbert explains, they are not in the first batch. I think someone else asked, why don't they do a buyback? I think that's actually sort of fairly straightforward because they're already, they've got a bit of gearing. So it doesn't make sense for them from a capital structure perspective to gear up even further to do a buyback at this stage. But Osbert has caught up with the company. and they are definitely exploring options to support share price, and a buyback could be one of them. And now, whether that's the best thing for them to do, probably not. I think reducing gearing might be a much more interesting thing for them to do. And for that, securitization will play a very important role. So that's the sort of summary of this idea. Osbert couldn't sort of join us today, otherwise he would have presented this himself. But just big picture, this is a very good contrarian cyclical to own into what should be a period of sustained improvement in order book for CCCC. And given the liquidity and market cap, it should be a fairly actionable name for most investors. Okay, with that, I'm going to swiftly move on to the last part of today's forum, which is actually a very tactical, very tactical section. Sell in May is something you hear quite a lot. I think this year, some of the reasons to at least take profit in May might be more apparent than in other years. And also there is a question of where would you want to hide if you do take some profit, right? So this is what we are exploring. Now, this sort of tactical positioning is something that Cam Hui covers very closely for us in the platform. Let me just sort of take you to his profile. So Cam is actually based in Canada. He runs a business called Pennock Ideas Hub. He's been a hedge fund manager, a technical research analyst, a strategist, a quant manager, and a special situations analyst. So he's an extremely experienced analyst. And I think a lot of his stuff is very, very practical oriented in terms of what you should be doing with your portfolio exposure levels. So, maybe the best way to explain this is just run you through this insight, which he published on the 26th of April, very timely going into the month of May. So first things first is he thinks markets are vulnerable and a pullback might have already begun. And he explains that. So the first reason he explains is that market internals are looking wobbly. Now, market internals is sort of, it's a bit of a tough phrase. People don't always know what they mean when they say market internals. But generally that means is that the sector composition and the stock level composition of the market is starting to sort of deviate from what would be a very healthy market. So in this case, for example, what Cam is pointing out is that 4 defensive sectors are actually starting to outperform the rest of the market. Now, typically when defensive start outperforming, it's a warning sign. It tells you that markets are consolidating, people are rotating out of, risk and into slightly more defensive stuff. So that's what he's showing in these charts. So healthcare, staples, utilities, real estate, they're all breaking out. So the second question is, what's happening with sentiment, right? So first of all, the market has already overrun all the strategists' target prices for the year. So unless there are some new positives that we discover, it's hard for the strategists to continue to sort of raise their target prices on the S&P. The third thing is when you look at II sentiment, right? So this is investor sentiment. I think the main thing to highlight is if you look at bull minus bear spread, that is now extremely overbought, right? So the spread is at 47. This is kind of like the highs that you see. Now, this is not always necessarily a sell signal, but typically from these levels, the market struggles to make new highs. The third is the divergence between what investors are thinking and what RIAs or the registered investment advisors are thinking. So I think this is quite an interesting signal. And these are the 2 charts. So, this is what we were looking at. The bull to bear ratio is all-time high, but the advisors are starting to turn cautious already. So, they're clearly trying to advise their clients to be a bit more careful. Now, there is some good news here. As Cam looks at it from a strategist hat on, he does not think that the pullback is going to be any more than 5 to 10%. So as I explained right up front, this is a very tactical call. but it's certainly a call to inspect the level of exposure you have, especially the level of exposure you have to poor quality stuff. You know, we've been talking a lot about companies and stocks that have very inflated valuations, but no earnings, no cash flow, no revenues, even in some place. So that is the sort of stuff that can fall 50% and the market just falls maybe 5%. So that's the stuff to be really careful of at this moment. And then, you know, one area which seems to make quite a bit of sense right now is the gold miners. As you know, commodities have done extremely well. We discussed reflation as a core idea when we sort of kicked off the year. So we've seen, you know, we've seen commodity prices do well, but, you know, gold has lagged. Gold has been seen as a sort of risk aversion proxy, not really an inflation hedge. But what we're starting to see is some of that underperformance now being recaptured. So if you look at the gold mining stocks, GDX is an ETF. It's a VanEck ETF. That's actually broken out of its range. The bullion itself, you know, is a laggard. So if you look at gold price itself, it hasn't broken out, but the miners are trying. So I think at this stage, sticking with the miners relative to the bullion is something that Cam thinks could be an interesting idea. So again, just summarizing, you know, this is very, very tactical. So this is not sort of about long-term positioning, but this is really about some of the risks that are embedded in current market prices at this level. Okay, over to questions. Over to you now. And I've got a first question coming in, which is, this forum has been highlighting some China stocks with low valuations. Example, Sinotrans, previously CCC today. But China stocks have historically been on low valuations because of reliability of the account. How should one take this risk into account in considering these stocks that have been highlighted? Okay. Well, first of all, this forum has not highlighted only China stocks with low valuations. You know, we've spoken at length about companies like Alibaba, about Tencent Music, about Xiaomi, some on the long side, some on the short side. So what's very important is this forum picks ideas using a data-driven approach where we look at what has started to trend amongst the institutional client base of Smartkarma. And based on that, we filter, refine, and screen for ideas. So that's just to set the record right. Now, China stocks have been on low valuations because of reliability of accounts. I'd actually challenge that statement. I think there's enough China stocks that trade at ridiculous valuations, too rich. So that's not necessarily true. Reliability of accounts. Okay, yes. I think reliability of accounts is especially a concern with companies that have VIE structures. So a lot of these are ADRs, so they are US listed stocks, and one definitely needs to stick with quality and track record with such companies. Now, CCCC and Sinotrans, for instance, these are government-run companies that pay big dividends and are ultimately owned by the government. I think the one thing I can't accuse such companies of is reliability of accounts. I can certainly accuse them of maybe not being the most efficient deployers of capital, or maybe not being the most growth-focused companies. But I think relatively speaking, at least, the accounts are so bad that the reliability is not something that I would necessarily worry about. So again, you know, stocks that are offshore listed, especially with VIE structures, certainly. I think the reliability of accounts and reliability of control is something that we need to focus on quite a bit. But with some of these SOEs that, you know, are government-owned, pay dividends, and if anything, have reported really bad accounts, not good, I think that concern is a lot lower. Good question there. Cool. Perfect. Well, look, just maybe if in case you guys are still thinking of any other questions, but maybe just to summarize, you know, the forum is a two-way street. So keep bringing us ideas or themes that you might want to discuss. You know, these might be ideas that haven't done so well necessarily. So a great example for that, for instance, is, you know, in the last couple of weeks, we've seen a pullback in some of the Macau names on the back of earnings, which is a very backward-looking thing and could be a great opportunity. Or, even things like straight trading, which, almost doubled from the time we presented it and discussed it, but has given up some of the profits in recent days. Feel free to bring us ideas that you'd want to revisit. Just drop us a message on the platform, and just help us improve the forums the way you'd like them to be. But with that, I'm going to say thank you for your time, and see you next week. Bye-bye.